What's up everybody, Gen X Dividend Investor here. In this video I explain why a lesser known metric called shareholder yield is arguably more important than dividend yield, yet most folks aren't aware of it. I'll then end things by sharing how stocks have historically performed after interest rates have been cut, as that possibility seems more likely these days. Feel free to use the timestamp on screen if you want to skip ahead to where I start going over shareholder yield, but I recommend you don't jump ahead as I'm going to share some valuable information on dividend yield. Okay, to start with, pretty much all dividend investors understand the basics of dividend yield, which is just a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. So if I owned $100,000 of a stock that was at a 4% dividend yield, then I'd expect to make $4,000 in dividends from it in the next 12 months, assuming the company didn't raise or lower their dividend. And to simplify it even more, think of it like this. When you buy a stock, you're buying a small piece of a company, and thus are becoming a part owner of it. You're basically buying a tiny slice of a big pie. That slice is called a share. It's your share of the pie. When your company makes money, it can decide to give some of that money to people who own slices of the pie. And the amount you get paid, which is a dividend, is based on how much you own combined with how much they pay out. Calculating dividend yield is like figuring out how much money you get back from the company compared to how much you paid for your slice of the pie. Pretend you bought your slice or share for $100, and let's say the company pays out $5 per share over the course of a year for each share you own. That means the dividend yield would be 5 divided by 100, which is 5%. Thus, for every $100 you invested, you would expect to get back $5 per year in dividends. The dividend payout for the company only changes if the company's board of directors votes to either raise or lower their dividend. Take a look at the dividend yield of an energy company I'm an owner in Exxon Mobil, ticker XOM. Exxon is my 8th largest position of the 28 tickers I own. I have 1,205 shares of Exxon, and its current price is about $118 a share, which means I own around 142 grand of it. Let's look at some dividend info on Exxon using Seeking Alpha, which I'm an affiliate of. This says that Exxon's dividend yield at the time I took this screenshot is 3.21%. This also shows that its last dividend amount was for 95 cents, and it pays out quarterly, so that means Exxon pays out $3.80 per share per year. So my Exxon position pays out 1,205 shares times 95 cents per share per quarter, which is $1,144.75 per quarter, or $4,579 of dividends per year. And if we do the math, we see that $3.80 of dividends per share per year, divided by its current price of $118, gets us to that 3.2% dividend yield that Exxon has. Now, some people might say, who cares about a 3.2% yield when I can get 5% in the bank these days, but hang with me and I'll get back to responding to those people. Okay, so we know that a company's stock price changes throughout the trading day, which means its dividend yield is also changing throughout the day. But the amount of dividends you get paid is simply based on how many shares you have times how much they pay out, so the fact that the stock price goes up or down doesn't change how many dividends you get paid for the shares you already bought. No, instead a moving stock price just changes how many shares you or someone can buy with their money, and the dividend yield will represent how much those latest shares should pay out in the next 12 months. And that's why buying something when it's cheap means you get more shares for your money, all of which means more dividend income relative to buying when something was more expensive. Take a look at this 2 decades worth of Exxon Mobil data on macro trends. The top chart is Exxon's stock price over time, and you can see how it's gradually trended up, though we had a dip a few years ago when the pandemic hit us. The middle chart is Exxon's dividend payouts over time, and that trend is a nice smooth one, only going up, because Exxon is a dividend aristocrat that has paid and raised its dividend each year for 42 consecutive years. And then the bottom chart shows Exxon's dividend yield over time, and you can see how it fluctuated a bunch throughout the years. Right now we see that Exxon's dividend yield is around 3.2%, which means if you invested $100 in Exxon shares today, you'd expect to make $3.20 of dividends in the next 12 months, assuming no dividend changes. Or if you invested $1,000 into Exxon shares, then you'd make about $32 in dividends over the next year. Doing the math, you can see that $1,000 invested in Exxon divided by its current share price of $118 per share would get you 8.47 shares. Each share pays out $3.80 per year, so 8.47 times 380 equals $32 of dividends per year. That means that after you bought, if Exxon's stock price fell 50% tomorrow, you would still get $32 of dividends in the next year. Again, the amount of dividends you get paid is based on how many shares you own and how much each of those shares pays out. It's not based on a changing stock price. I repeat that because new folks are frequently confused about it. That also means if Exxon shot up to $500 a share, you would still get paid $32 in dividends from your 8.47 shares. And if Exxon really did shoot up to $500, then its dividend yield would fall to $3.80 divided by 500, which is 0.76%, i.e. less than 1% dividend yield. At that point, if you invested $1,000 into Exxon, then you'd only be able to buy 2 more shares, each of which would continue to pay $3.80 per year in dividends. So $1,000 invested when Exxon costs $500 a share will obviously yield you a lot less than when it costs $118 a share, though each individual share you own will yield you the same amount whether you bought it when it's cheap or when you bought it when it was expensive. There's a term called yield on cost to be aware of, but feel free to watch my video I did on that topic called Dividend Yield on Cost, why some love it and some don't. Okay, so let's say that you determine that $500 is too much to pay for more Exxon shares, so you stick with your 8.47 you already have. Your shares would be worth 8.47 times 500, which equals $4,235, and we could use two simple ways to know how much dividends your position would pay out. Number one is to just look at the number of shares you had times the dividends paid out per share, which would be 8.47 times $3.80 per share, which equals $32.33 of dividends per year. Or number two would be to look at the total amount of Exxon you own, which is $4,235, and then multiply that by whatever its dividend yield is at that moment, let's say 0.76%, and 0.0076 times 4,235 equals about $32. Either way works, though number one tends to be more precise. Hopefully now you understand why a stock's dividend yield changes throughout the day as stock price changes, and why your dividend payout doesn't change on shares you already bought, even though the current yield of the moment is changing. To really understand how much dividend yield can change over a short period of time, take a look at what Exxon did when the market crashed during the pandemic. This chart shows that Exxon fell down to around $31.48 a share around that time, pushing Exxon's yield to over 9%. Assuming you bought when Exxon was at that price, that means someone who invested $1,000 could have bought $1,000 divided by 31.48 per share, which equals 31.7 shares of Exxon, and at that time Exxon was paying $2.88 a share, which means 31.7 shares times $2.88 per share equals about $91 per year of divvies on that $1,000 investment, aka a 9.1% dividend yield. Okay, now let's get back to the people who say who cares about Exxon's current 3.2% dividend yield when they can make 5% in the bank, and the bank is a lot safer. But what those folks may not be factoring into things is that not only do good dividend stocks tend to increase their dividend the longer you hold it, but they also often appreciate over time. Now, oil stocks are actually some of the more volatile investments which can go up or down quite dramatically based on macroeconomic conditions, but buying when cheap can often enable good short to medium-term stock appreciation opportunities. A key thing to realize is that cash in the bank and cash equivalents like treasury bills or money market funds all have historically significantly underperformed stocks and other asset classes, generally speaking, over the long run. And that makes sense if you think about it, because there's a very low risk chance of losing your cash if you hold it in the bank, and lower risk usually means lower returns, whereas higher risk investments like stocks tend to give you better returns, at least over longer periods of time. This chart I found on Visual Capitalist shows the growth of the S&P 500, corporate bonds, gold, treasury bonds, real estate, and cash from 1970 to 2020. What we see is that the S&P 500 has materially outperformed all those other asset classes, with gold and cash near the bottom. These days gold is hitting all-time highs, but over the very long run it's been a poorly performing asset as compared to the stock market, even though over shorter time frames it can be great. But just because something might not have the best long-term returns doesn't mean you shouldn't hold it. I mean, you might want to hold gold or whatever asset in your portfolio to diversify things more, or maybe you hold things to provide some downside hedging protection or whatever. Anyway, my point in sharing that graph is to highlight that cash in the bank tends to not outperform good investments, though obviously holding some cash is smart. And if you've been a long-time subscriber of mine, then you'd know that before I started my YouTube channel, I went through something that influenced me to sell out of all my stocks for a short period of time and move my proceeds into a broad market ETF, and then afterwards I got back into my tickers. It was a big deal for me to do that, but you'll understand why if you watch what was my hardest and most emotional video to make called The Time I Sold My Stocks. Okay, so my Exxon position is currently worth about $142K right now, and so if I sold it all and put that cash into the bank account, making 5% a year, I'd make $7,100 in interest, beating out my annual dividend income for Exxon, assuming interest rates stay high. But I've also made around 150% return on Exxon since I got back into it a few years ago when I look at dividends plus stock appreciation. So like I've made about 24 grand in dividends from Exxon and have gotten a ton of stock appreciation that I've not yet realized as I've not sold it. Thus my total returns from buying and holding have far outweighed what I would have performed if I had just held cash. Of course, Exxon is something that I expect will crash at some point, so if I wanted to play the game of buying low and selling high, especially when interest rates are higher, I could do that. But I prefer the lower stress approach of buying when it's cheap and then holding, even though I don't have the long-term confidence in oil stocks to keep trending up, like I do with most of my other tickers. The truth is that very few people can consistently and successfully sell stocks at highs, buy at lows, stay in cash while interest rates are good, etc. That doesn't mean what I'm doing is good or bad, I'm just sharing how I tend to operate. I'm someone who prefers to stay light on cash because I like it working for me in stocks, but some awesome investors like Buffett are currently holding a ton more cash than me for a variety of reasons, so you should do what makes sense to your risk tolerances and needs and such. I actually did a video called How Much Cash Should You Hold if you'd like to hear my nuanced thoughts on the topic. Okay, with that understanding behind us, now let's move on to shareholder yield. Shareholder yield offers a more comprehensive picture of how companies return value to shareholders as it looks at dividends, share buybacks, and debt reduction. By considering all three of those factors, shareholder yield provides a fuller view of a company's commitment to creating value for its investors. So while dividends offer direct cash returns, share buybacks can increase the value of remaining shares, and debt reduction improves the company's financial health. And remember, there are two main ways companies return cash to shareholders, and that's buying back shares or paying dividends. Buybacks are a less direct way, but can be a more tax-efficient way than dividends. Dividends are something that once a company starts paying them, they tend to keep paying, because that's usually what the markets expect. That also means that paying dividends reduces the flexibility for capital allocation that management teams have, which is why they sometimes prefer doing buybacks more than pay divvies. Now, a company can decide to issue new shares, buy back existing shares, or can do both at the same time. Issuing shares often go towards employees and executives, whereas share buybacks are frequently done in larger amounts to reduce the overall number of shares outstanding. A key purpose of reducing share count via buybacks is to increase the ownership percentage of each remaining share. So like if a company consists of 100 shares, then that means that each share is worth 1% of the company. If that company uses their cash to buy back 10 of those shares and cancels them, then there are only 90 shares in the market, so now each share owned would be worth 1.1% of the company. When companies take shares out of circulation, it makes it easier for them to pay and hike their dividends. Like, pretend that 100-share company was paying a dividend of 10 cents per share per year, which means they would be paying out about $10 a year in divvies to their shareholders. If they did a huge buyback of 10% of their shares, leaving them at 90, then that would mean they'd only be paying out $9 a year in dividends. That would easily let them do a 10% dividend hike to 11 cents per share per year, taking their total dividends paid out to be 90 times 11, which equals $9.90 per year, which would still be paying out less than they were before. So their buyback allowed them to not only increase everyone's ownership percentage, but it also gave them an easy ability to do a 10% dividend hike and still end up with having more cash left over, which they could use for growth or debt reduction or future dividend hikes or acquisitions or whatever. I did a video called Should Dividend Investors Love Stock Buybacks, which I recommend you watch if you want to understand more about buybacks. Anyway, when companies buy back shares, it also tends to increase their earnings per share growth, which the market usually likes to see, and share price appreciation also often follows. So my point is that looking beyond dividend yield is important, and shareholder yield is often a more interesting measure of return of capital than dividend yield because it covers multiple things, though dividend yield is still an important metric. Okay, and there are various ways that you can calculate shareholder yield. One is cash dividends plus net share repurchases plus net debt paydown, all divided by market cap. Cash dividends are just the amount of dividends declared and paid by the company. Net share repurchases is the difference between the dollar amount of share repurchases and the dollar amount of share issuances. Net debt paydown is the difference between the amount of debt paid down and the amount of debt issued. Market cap is the number of shares outstanding times the current stock price. For example, assuming a company looked like this, then its shareholder yield would be 4.15%. A higher shareholder yield is generally what you're going for, as that would mean that the company is returning value to shareholders through a combination of cash dividends, share repurchases, and or debt paydown. Another way to calculate shareholder yield is by taking its dividend yield and then adding in its buyback yield and its debt paydown yield. Buyback yield is just the percentage decrease or increase in shares outstanding. If a company's shares outstanding are declining, then that would mean its buyback yield is increasing. For example, assuming a stock has averaged 90 million outstanding shares during its most recently reported quarter and averaged 100 million shares outstanding during the same quarter a year prior, the buyback yield would be 10%. To calculate debt paydown yield, we calculate the percentage decrease or increase in debt relative to market cap. So now let's pretend we had two hypothetical companies. Company A pays a dividend yield of 2% and Company B yields 5%. If all one cared about was dividends, then Company B looks more attractive. But when we also look at the yield you're getting from buybacks and the positive aspects you're getting when they pay down debt, all of which gives us shareholder yield, we see that actually Company A looks more attractive with its 11% shareholder yield versus 7% for B. Of course, never blindly buy or sell solely based on shareholder yield, as there's a lot more to a company that you want to dig into. Plus, you could be fooled by a high shareholder yield. I mean, what if the reason it's so high was because its dividend yield was super high, which itself can mean more risk to be aware of. That being said, there was a study done a few years ago called the Long-Run Drivers of Stock Returns, Total Payouts in the Real Economy, where they found that the prevalence of buybacks in the US market caused traditional dividend discount models to underestimate expected stock returns, making a total payout model, i.e. net buybacks plus dividends, more predictive. They found that total payouts almost entirely explain realized returns from 1871 through 2014, which implies that companies with a high total payout should outperform companies with a lower total payout. Specifically, they found 97% of realized returns are related to the supply of total payouts. So higher shareholder yielding stocks tend to outperform the broader stock market as well as high dividend paying stocks. A different study called Enhancing the Investment Performance of Yield-Based Strategies found that stocks with shareholder yields ranking in the top 40% experienced higher annualized returns when looking from 1972 to 2011, excluding financial stocks. And of course, remember that shareholder yield is using historical data, so just because something happened in the past doesn't guarantee it will happen in the future. Okay, and then here's a chart from a study that compared what investing $1 in 1982 until 2013 would have grown into based on different large cap investing strategies. The lowest performing ended up being the SP 500, where your $1 would have grown into 35 bucks. Better was had you invested in the top 10% of large cap stocks by dividend yield, which would have gotten you a total return pushing your buck up to 51 bucks. Even better was if you'd invested your dollar in the top 10% of large cap stocks by shareholder yield, which would have pushed you up to 157 bucks over that same time period. And your best performance would have been if you invested in high quality shareholder yield stocks, taking your dollar up to 224 bucks. They concluded that shareholder yield generates alpha in large cap stocks when you use their criteria for stock selection, and I'll include a link to that study and all the data I used in the description of this video. Note, I found a few shareholder yield ETFs that you might want to peruse, though they're relatively small and new ETFs, so I personally wouldn't invest in them, but it'll be interesting to see how they perform over time. Okay, and if you don't want to calculate your own shareholder yields, then another option is to go to suredividend.com and get a copy of their shareholder yield spreadsheet. They have a few hundred dividend tickers in here, including many popular dividend stocks. I highlighted a few of my tickers in green. So like AbbVie has a 4.4% shareholder yield, Caterpillar has a 4.3%, Colgate-Palmolive at 3.3%, Chevron an 8.5%, Home Depot a 4.5%, etc. But again, you don't just want to sort a list like this by shareholder yield and blindly go with the top ones, as I'm confident you'd end up with a lot of really risky stuff. However, it would be helpful in your investing analysis to look at a company's buyback yield percentage trends and its debt trends and not just hyper-focus on yield. Hopefully now with all that you have a better understanding of dividend yield and shareholder yield amongst other things. So let's switch gears and quickly talk about how stocks have historically performed after interest rates have been cut, as that possibility seems more likely these days. Plus the stock market being at basically all-time highs means some people are getting skittish about where things will go from here. Many experts think we'll see a 25 basis point cut, lowering the target interest rate to be between 5 and 5.25 percentage points, though other experts think it might be lowered by 50 basis points, which itself could freak some people out as that might imply that the economy is doing worse than we've been led to believe. Looking at how things have happened in the past, what we find is that when rate cuts were followed by the onset of a recession, like in 1990, 2001, and 2007, stock prices were lower 3 and 6 months out after the first rate cut. In contrast, when the first rate cut did not precede a recession, like in 96, 98, and 2019, investors saw good returns over the following months. An outlier to all that were the gains we got when rates were cut at the onset of the pandemic, but those economic conditions were so unique that it probably isn't useful to include in this analysis. So TLDR, deciding whether it's a good idea to sell the news of the first rate cut depends on whether you think that Powell is cutting because inflation is cooling and that's allowing him to do it, or is he doing it because we have a severely weakening economy and so he has to do it. I personally just plan to hold regardless of what he does, but for those of you that might be more aggressive, then the answer for what you should do will probably be influenced by both the reasons for any rate cuts they do along with the outlook for the economy. And with that, I'd ask that if you got any value from this video, then I'd really appreciate it if you hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my videos. And I'd recommend that you check out my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off the first payment even if they sign up for a full year. I'd also recommend you check out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there are any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you'd probably like. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 82 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.